Hey Bowtie Nation, Joseph Hogue here, and we talk a lot about investing and making your money work for you here on the channel, but sometimes I feel like it's just too easy to forget how hard it was just to get started investing. Like how difficult it can be to invest your first $10 if you don't even understand how to buy a stock. Now that's my fault, and it's why I paid a visit to two of you out there in the community to get your questions on how to start investing.
It still was the fear of not really knowing what you're doing, not really knowing the terms of investing, not like what kind of account that you want to open. I had no idea. I just started with like an individual, I guess an individual account, and just started there. But it's definitely knowing what you want to invest in.
That's Brian and Crystal, two citizens of the Bowtie Nation, and they have exactly the same questions you do on how to get started investing, how much to invest, and where. So in this video, I want to give you a step-by-step to start investing for beginners. I'll show you everything from how much to invest, how to open an investing account, and which accounts you'll need. We'll also look at how to find stocks to buy and how many stocks to own. Whether you're investing your first $10 or first $100, you'll find exactly how to do it in this video. Along the way, we'll be following Brian and Crystal's journey as they start investing and what they've learned, because you're going to hear a lot of the same questions, the fears, and the doubts that you might have about getting started. You are not alone in this, and I know you can get started.
Whenever you open an account and you see the amount that you started with and you see the dividends roll in and they're automatically reinvested and you can just watch your amount just continue to go higher and higher. I mean, it's hard to explain the feeling of excitement.
It is an inspiring story, and I know one that will motivate you to change your life. But we can't get started here on the channel without that special shout out to all you out there in the Bowtie Nation. Thank you for spending a part of your day to be here. If you're new here, don't forget to join the community and check out the playlist in the video description below. Besides that step-by-step to start investing in this video, we're following Brian and Crystal's story in 5 videos to show you how to create wealth from making money to investing and beyond. And we're getting started with something 99% of the investors out there neglect, but I promise you, do this first part right and you will reach your goals. Getting ready to invest. Most new investors won't do this or just don't understand how to do it right. They jump into picking stocks and never really think much about things like how much should they be investing or how much risk they need. They might spend all of 5 seconds thinking about their goals, but only in a way to think about some random number like $1 million in 10 years. And what happens is they fall into the biggest investing traps, bigger than picking the wrong stocks, worse than paying too much in fees. So give me 5 minutes here just to help you get ready to invest. Talk about your goals, how much to invest, debt, and risk, and I guarantee it will be the best return on your time you ever got. But now you've got your goals to motivate you. You've already watched that side hustle video last week, so you've got extra money coming in to invest. Now the only question is, how much should you invest? And you're going to hear a lot of rules, like invest 10% of your income, or a calculator's telling you how much you need to invest. But they all leave out one crucial detail. Your own income and your budget are going to determine how much you need to invest each and every month. So here, I want you to figure out what's left in your budget after paying those must-pay expenses. It would be great if you could start with investing at least $100 or $150 a month, but if you can't do that, just start with whatever you can. And what's important here is that you just get started investing. You start building that habit of putting money in stocks no matter how much, whether it's $250 a month or $25.
Anybody can be an investor for $1 a day. I started out with like $10 a week, but hey, you gotta start somewhere. Now that I have gotten a little more comfortable with investing and the business, since we have the business, where I'm able to do $300 a month now compared to the $10 a week beforehand. So the business has afforded us to do that for sure. I mean, my goal is to get up to $500 a month. That way I can fully fund a Roth IRA, but we're still working, so we're getting there.
I love how Brian and Crystal are using their side hustle and their passive income to invest more, using that complete wealth creation process that we're talking about in this series. The fact is, though, you can start investing with as little as $1, and the power of compounding, what Einstein considered the 8th wonder of the world, means even a little bit goes a long way. Investing just $100 a month grows to over $86,000 in 20 years, and you'll end up making over $62,000 of profits. Even on $50 a month, you'll still have more than 40 grand in as little as 2 decades. But as exciting as watching your investments grow will be, I need to warn you here. You also need to find that balance between investing every penny you can find and having a little fun along the way. Nation, I have seen too many investors get started, get excited, and then save every penny available, putting everything into their portfolio. And unfortunately, one of 2 things almost always happens. One is an emergency expense comes along, something I like to call that's life. Whether it's a new something for the car or that little time Joey wanted to try dirt bike racing. And when this happens, if you don't have some emergency savings, you're gonna have to sell some stocks and take it out of your investments. Not only might it be the worst time to sell, but it's just so demoralizing, so frustrating to see your investment balance go down that it destroys a lot of people's motivation to invest. And the other scenario here is a lesson I learned the hard way, saving every penny I earned in my early 20s, working 2 jobs and investing for that singular goal of retiring early. The only fun I was having was that fantasy of someday not having to work anymore. But folks, the truth is, what good is it to be miserable for 30 years of your life just on the hope that you'll be able to spend that money decades from now? In fact, too often what happens in this kind of penny pinching to save and invest every single dime, it just burns you out. You burn out every 6 months like I did, go on a spending spree, and set yourself back to the start. The good news is there's 2 simple steps here to help you avoid both of these traps. First, have at least 1 month's worth of expenses saved up for emergencies. Now, I know most people will recommend like 3 to 6 months, but get started with just 1 month, just to get started. For most people, that's going to mean $2,000 or $3,000 in an emergency savings account. Now, the other step, just don't forget to budget a little fun in your life. Reward yourself each month with a night out or something you can do to recharge. Now, related to that idea of how much to invest is, should you pay off your debt first before you get started investing? And I think Crystal says this better than anyone.
When you first learn about debt and investing, everybody's heard of Dave Ramsey, and he wants you to stop all investing and pay down debt. But we've learned that time is as of essence. I can't talk. And compound interest is in our favor. So we have definitely learned that investing now is also important, just as important as paying off debt, because the younger you are, the more money you can make because of time. So I think investing has given us definitely a better chance now as opposed to waiting until debt's paid off to have a better future.
Now, by all means, if you've got that high interest debt, like 18% or more on credit cards or those personal loans, pay that debt off. That's a guaranteed return on the debt you pay off there, but it doesn't mean that you have to be debt-free before you can start investing. Because the tragic fact is, a lot of people will never be completely debt-free. I'm going to admit it, shopping is just too much fun, and you can't buy the shoes without the shirt and the bow tie to go with it. But you know what we will all be, God willing, old and needing something to live on. Even if you can't be completely debt-free, you're still going to need something to help you pay the bills, and Social Security is not going to cut it. You're now ready to invest. You've thought about your goals and debt, and you're already way ahead of most new investors, but now you're sitting there in front of the computer and thinking, okay, what the hell do I do now? How do I invest my money? Here, I want to show you 3 investing strategies every beginner needs to know and some tips to making money in each. We're getting into the fun part of investing right now. The first of these 3 main investing strategies is investing in growth stocks, and this one has been extremely popular over the last few years. Now, investing in growth companies focuses on finding those stocks with faster revenue, faster earnings growth. Remember that a stock's price is largely determined by those future earnings, how high the market thinks the company can grow those profits. So these stocks with that earnings growth of 30 and 50% a year can see the stock price boom higher. Now, a great example of this is cybersecurity company Zscaler, which I recommended back in September of 2019. Shares are up 647% over the last 2 years on a doubling in revenue and earnings that have jumped by 55% a year. So the upside to growth stocks can be amazing. These are innovative companies changing the world in which we live, and any one of them could be the next Tesla or Apple. But as we say here in the nation, not all of it's rainbows and unicorns. There are 2 downsides to growth investing. First is that you can be just as wrong about a company. It might not be the next growth stock that you thought it was. Maybe earnings or growth slows and the share price goes nowhere. The other downside, and this one can be even worse because it is so frustrating, is the stock price for growth stocks is just as much a function of investor sentiment and the market. Let's look at an example here and I'll explain this. Shares of payment leader PayPal surged 169% in the 18 months to June of this year, nearly tripling investors' money, but have plunged 36% since then. Now, PayPal is still a leader in its business, still expected to post a strong 20% annual growth in revenue and profits for years to come. And nothing fundamentally has changed about the company, and yet investors have just sold it lower. The market was in love with growth stocks over the last 2 years, and money rushed into these stocks. That pushed prices up, but it doesn't last, and a lot of these companies, still great companies with solid future growth, have seen their share prices tumble. Now, for you long-term investors out there, someone planning to hold their stocks for decades, it's not so much a problem. Growth companies grow. It's in the name. So earnings are going to keep growing and eventually justify that higher stock price, and returns are going to be great. But looking for those growth stocks, you're going to be focusing on a few things here. Most important is going to be not just that past growth. Has the company been able to grow its sales and earnings over the past few years, but that expected future growth? Do analysts expect those double-digit growth rates to continue? And these are also usually smaller companies with room to grow. You're looking for those newer companies with an innovation or a breakthrough that is changing how business is done in that industry. Now, the other side, kind of an opposite perspective in strategies, is value investing. Now, in value investing, you still want to invest in companies that are growing their earnings because that's what drives the stock price. But you're also going to focus on how much investors are paying for those earnings. You're looking for cheap stocks. And here you're looking at valuation measures like the price to earnings or the price to sales ratio, which I'll show you how to use later in this video. You're looking for companies where investors are paying less, a lower price for each dollar in earnings. And let's look at an example here with Wells Fargo, a traditional bank versus that new technology alternative in PayPal in that last example. Shares of Wells Fargo trade for a price of 12 times its earnings. That's that $49 share price divided by profits of about $4.19 over the last year. That means to own the company, investors are paying $12 for every dollar in earnings, that price to earnings ratio. So if we compare that to shares of PayPal with its price of 45 times earnings, it's easy to see the attractiveness of value investing. Basically, you're saying, if I'm going to become an owner of a company through buying this stock, I want to get a good deal out of it. I don't want to pay $45 for every dollar of profits. I only want to pay $12. And pros of value investing are that it has historically beaten growth investing on those returns. Here you see the portfolio value of a group of value stocks in blue and growth stocks in brown, and the difference has been widening for decades. Value stocks have beaten growth stocks, except for recently. Here you see the growth stocks in blue and value in red, but only over the last 20 years. And you can see since about 2014, growth stocks have outperformed with higher returns. Now, that is not to say that value stocks won't once again start beating growth investing, only that the rule doesn't always play out. Another advantage of value stocks, though, is they don't tend to fall quite as hard as growth stocks in a stock market crash. The shares are already cheap, right? So they just don't have as far to fall. Now, looking for value stocks, you're focusing mostly on those valuation measures that I'll show you later. You're looking for stocks with a low price to earnings ratio or low price to sales. You still want to invest in companies that are growing those earnings, but your primary concern here is getting the best deal possible. This third strategy, dividend investing, is a fan favorite here on the channel, and it's easy to see why. Dividend payments have accounted for more than 40% of the total stock market return in the past, and even when stock prices drop, that dividend is a positive return for investors. The best part of dividend investing, though, is just the feeling you get seeing that payment hit your account.
The best feeling about investing is definitely when the dividends roll in, man. It just makes your day. Crystal gets so excited.
I'll text him and say, Adby just declared a dividend. And I have so many shares, and this is how much I'm going to get.
Yeah, it's definitely, it's great. How can you beat it?
Now that actually sounds a lot like passive income. Yeah, maybe not quite as good as the 5 passive income ideas we covered in our third video, but pretty darn good. With dividend investing, you get regular cash flow you can reinvest or just use to pay the bills. Another upside here, though, is these stocks are usually stable companies, and many are value stocks. Now, the downside to dividend investing is it's tough to find growth stocks that pay dividends. A company growing sales and earnings quickly is going to be using those earnings to grow, not paying them out to investors. So what you usually see is the share price of these dividend stocks doesn't usually increase quite as fast as you get with those growth stocks. Now, whatever strategy you decide to follow, or whether you're a long-term investor or not, your biggest question then is probably, how do I find stocks to buy? And just about every video on the channel is about how to find those best stocks, whether through analyzing the news or doing that fundamental analysis on your stock picks. So here I want to step back a little bit and focus on where to find that information and what to do with it. The fact is, though, you do not need to spend a lot of time researching and picking your stocks. I'll show you how to do all your investing in as little as an hour a week, but when it comes down to it, a lot of you are going to find that you want to spend more time following the stock market.
I get in my portfolio every day just to look and see what's going on. I don't necessarily do anything with it, but I like looking at what's happening here and what's happening there and reading the news about what's going on.
With that long-term investing strategy, you're really only looking for maybe 10 or 15 stocks to buy and hold for years. It's not going to take that long to find a handful of companies you really like and to fill your portfolio with those stocks. In fact, most of your time investing is just going to be spent keeping up with the news and the ideas on those 10 or 15 stocks. So then answering that question of how much time you spend following the stock market is really going to be up to you. Some of you will want that stress-free strategy of just a couple hours a month, checking in on your portfolio and investing new money into your stocks. Others, like Brian, are going to feel energized following the market and check in on your stocks every single day just for fun. So let's look at a few trusted resources here to find your stock information, and you're going to see me use a lot of these on the channel. The best free resource with some great information is Yahoo Finance, where you'll find news and data on each stock. One warning on Yahoo Finance, though, something I'll explain more in a bit, is you really have to watch out in this news section. You'll find a lot of useful and legit news sources, but there's also a lot of these infotainment articles that are more entertainment than good investing advice. Another free resource to learn about stocks, right here in the Let's Talk Money community. You'll find over 700 videos on investing, and even in those stock picking videos, I try to include an educational component to help you become a better investor. We also have a private Facebook group with some great conversations and a weekly newsletter with all the news, strategies, and tips you need. It's all completely free, so don't forget to join the community by tapping that subscribe button. For legit news sources, it's hard to go wrong with the Wall Street Journal and Bloomberg. These are probably a little more advanced than you're going to need to start investing, but I like them because they aren't filled with that kind of entertainment investing that you see on other websites. And an honorable mention here has to go to CNBC for news and investing ideas, though this is where that warning has to come in. Because nation, for better or worse, the fact is that investing has become an entertainment industry. Understand that a lot of these websites run on an advertising model. That means the more visitors they get, the more advertising they sell, and the more money they can make. It also means they need to make investing as dramatic, as exciting, and as much fun as possible. Unfortunately, it also means that not everything you see has your best interest in mind. You'll have to constantly be on the lookout for information there to lure you in with those exciting promises of getting rich, or there to actually help you become a better investor.
So much of it out there it's hard to understand. They talk in circles and they talk around things, and they'll make a bad company sound great, but do they really know? There's so many people out there, I think, misleading people.
The very best resource for research and information is usually going to be the investing app or the platform you use to invest. Most of these come with free research reports, and since they run on a different business model, they're not filled with that kind of infotainment advice that you see in those free resources. I'm excited to get into this next section, where to invest, actually putting your money to work. And this is what you came for, right? A step-by-step to answering some of the biggest questions on how to start investing. We'll start out with a review of some of the best investing apps and how to find the perfect investing site for your needs. I'll then show you how to buy a stock and even when to sell. Now, the first thing you have to decide here is where to invest. There are 1,000,001 investing platforms, but honestly, they're all pretty much the same. There are 3 things you want to look for here, and then I'm going to share which platforms I use. Now, first, you want to look for an investing site that doesn't charge you to buy or sell stocks. When I started investing all the way back in 1999, Brown & Company disrupted the industry by being one of the first low-cost brokers at $5 a trade, but even that's too much anymore. Most of the major brokers and investing apps have gone totally commission-free. Now, it's also nice to use a site that lets you invest in fractional shares. That means you can invest any amount of money in any stock, no matter what the stock price is at. You can invest $50 in shares of Amazon, and instead of having to wait and buy a full share for $3,000, the site's going to split up one share of stock and give you $50 worth. Third here is to look for a platform that gives you the investing tools and the research you need to invest. Now, this one isn't nearly as important as those other two, and some investors, especially beginners out there, might not even need any research tools. The trick though, when you're picking where to invest, is there's nothing wrong with having more than one investing account. In fact, between retirement and regular accounts, I have 9 accounts on 6 different investing apps. I use E-Trade and Merrill Lynch for research, Webull and M1 Finance for investing because of that commission-free trading. I also have accounts on Ally, Fundrise, and Moomoo. You can literally open an investing account in less than 10 minutes. You'll fill out your contact information and answer a few questions about your investing goals. You'll also answer some legal questions like whether you work as a financial advisor or for a publicly traded company that issues stock. You'll link your bank account to make those transfers easy, and you'll be ready to invest. I'll leave links to each of these sites in the video description below. For those of you that want a simple investing strategy that's easy to manage, I like M1 Finance for its automated investing tool and easy fractional share investing. And with M1, you pick the funds or stocks in your portfolio, then tell the platform how much you want to invest in each, and it's going to automatically invest any new money across each investment. I have an account on Webull for that stock trading and the deep research I need for analysis. Besides a really easy mobile app for investing, I love the stock simulator here, which gives you $1 million in play money to do what's called paper trading. So you get to test out your ideas and strategies before investing your own money. Now, Webull is also one of the most generous when it comes to a sign-up bonus, now offering 2 free stocks worth up to $1,000 each, so make sure you check out that link. Now, my oldest accounts, and where I have most of my retirement investments, is on E-Trade, which bought Brown & Company years ago. It's a great platform for research and different types of investments, including stocks, bonds, and futures trading. So here you've found a few stocks you want to buy, but how do you actually do the buying? How do you buy a stock in your portfolio? I'll show you how to buy a stock on E-Trade here, but the process is almost identical on any investing app. We're here in one of my accounts, and let's say I want to buy shares of everyone's favorite, Tesla, ticker TSLA. Now, if you don't know that abbreviated ticker symbol, you can just type in the company's name here in the dropdown, and it's going to show you that ticker. Here on the stocks profile page, you'll see all the basics like price, market cap, the 52 range in prices, and then across the top here, you can see a bigger chart, recent news, and even options trading. Let's say I've already done my research and I want to buy those shares, so I click buy over here. This order page is almost identical on any platform. You see the bid price of the shares, which is the highest price an investor in the market is offering to buy that stock. And here the ask price is the lowest an investor is willing to sell the shares in the market right now. Now, these two prices get more important if you're trading options because they can be a lot further apart. For the majority of stocks though, this bid and the ask price is going to be less than a few pennies difference and right around the quoted price of the shares. In this dropdown, you can buy, sell short, or buy to cover a stock. We'll select buy and then put in how many shares we want. Now, if you're on a platform that lets you buy fractional shares, this is going to be a dollar amount, how much you want to invest, rather than having to pick the number of shares. Now, for this price type, the majority of the time when you're buying stocks, you can just put in this market order. Now that's going to buy the shares immediately at the current market price. These other orders, like the limit order, are more for when there's a large bid-ask spread and you need to tell the app at what price you want the shares. Again though, not really an issue for most stocks. The platform is automatically going to show me the total cost of the trade and I'm ready to go. But now you've got a stock and maybe the price doesn't shoot to the moon immediately. In fact, what if the price falls? When should you sell? And the simple answer, of course, would be never. Just hold on to 3 exchange-traded funds, maybe 10 to 15 stocks you really like, maybe even 20 stocks until you retire and start living on your investments.
My biggest fail so far with investing, it would be, okay, when I very first started, I bought a share of Apple. I was so excited. And then, man, this is really putting myself out there. And then it went up in price, and I don't know for what reason. I don't know. I was just thinking crazy, and I was like, man, it went up in price. So I sold my share of Apple, and then I was like, man, I'll just buy it back now, and it'll be that much higher. And I got to thinking, I did it, and I was like, you big dummy. I mean, you just screwed yourself over. And it was a hard lesson to learn, and it kind of hurt down deep, but it was a valuable lesson. Don't get too excited, and
The highs and lows.
yeah, in the highs and lows, and don't make any rash decisions. Think things through.
We've all been there, making that mistake of selling too early, but sometimes you do need to sell, and you better know when that time comes. For me, it really comes down to 3 problems that I watch for in the company and the stock. First is if there's a scandal or a lawsuit and then no accountability by management. Hey, I understand. Bad things happen to good companies, and even the best run into problems sometimes. But if management doesn't step up and say, this was my fault, here's what I'm doing to fix it, then I'm dumping the shares. Another problem I watch for is a company piling on too much debt. I've just seen this become a problem too often in the past. Companies go on an acquisition spree, buying up everything they can and then fund it with mountains of debt. Of course, those acquisitions never go as planned, and the debt payments just become unsustainable. The dividend is cut and the share price plummets, so I want to be out before that happens. Now, the third signal is if the stock price just reaches where I think it should be. And whenever you're investing, you need some kind of an estimate, whether it's from analyst targets or your own. How much is that stock worth? And I wouldn't necessarily sell the stock as soon as it reaches that target, but if it goes much higher, I'm looking for something with a little more room for a return. Now, if and when you do decide to sell a stock, the process is just as easy as buying. You'll go to your portfolio or to the individual stock page, and again, you're going to see buttons to buy or sell the shares. You'll see the current stock price. Make sure this box here says sell and put in the number of shares you want to sell. You can sell all your shares or just a portion of those you own. You'll also see the same price types, including market and limit orders, just like for buying. You'll use this market order most of the time, which is going to sell the stock at its current price in the market. If you want to only sell the stock if it reaches a certain price, you can then use this limit order or one of the other types. And that's it. If you used a market sell order, then your shares are going to be sold within a few seconds on most investing platforms. Those questions of how to invest are easily the most popular for new investors. Everyone wants to know how to find stocks, how to buy a stock, and when to sell. Just as important though, maybe more important, is this next section on how to manage your investments. Here we'll answer questions like how many stocks should you buy and how to get the most out of retirement accounts. I'll show you my favorite investing strategy for simple, stress-free returns and how to protect your money from taxes and fees. And hey, why not? Let's start with that investing strategy because I know it's going to make investing so much easier for you. It's the one I use for my own portfolio and works on so many levels. This strategy is called the core satellite approach because you have a core of investments that make up between 60 to 75% of your portfolio. These are in exchange-traded funds, ETFs. For example, you might have 15% of your money in the Vanguard Real Estate Fund, that's ticker VNQ, which holds shares of companies in the real estate sector. Maybe you hold another 10% of your money in the Vanguard Long-Term Bond ETF, ticker BLV, which is going to hold hundreds of bonds and pays a 3.3% dividend. Finally, maybe you hold another 50% of your portfolio in a few funds like the ProShares S&P 500 Dividends Aristocrat ETF, that's ticker NOBL. That's a fund of the best dividend stocks in the market. So by investing most of your money, that core 60 or 70% into 3 to 5 funds, you get instant diversification across stocks, bonds, and real estate. Your money is spread out across hundreds of stocks. You've got bonds in that bond fund and cash flow from the real estate fund. Then, with the satellite portion of your portfolio, the remaining 25% or so of your money, you invest in individual companies that you really think could produce those higher returns. And this investing strategy works so well and on a couple of different levels. First, you get that broad investment through the funds. You get investments in all the asset classes and themes. Now, these are diversified and less risky because they're spread out across hundreds of stocks, so you really don't have to worry about this money. It's going to churn out that market return every single year. But then it also gives you that opportunity to make the higher return on that small group of individual stocks. Because you're limited to how many stocks you can buy, you're only focusing on the very best companies. You're not spending hours analyzing stocks every week because you've got your favorites and you don't need to chase every hot stock you hear about. So now you've got that strategy, but the question is, how many stocks should you really buy? You get all these great investing ideas every day online or on TV, and it can be very easy to build a portfolio of hundreds of stocks. You just keep investing in everything you hear about. You really don't need to. Research shows that once you get maybe 20 or 30 stocks, your overall return starts to look a lot like the average market return because you're so diversified. You've got a little bit of everything. That's another reason why I like that core satellite strategy, having those 3 to 5 funds that's going to give you the diversification you need in those asset classes. Then just picking 10 or 15 stocks of companies you really like, stocks you think could do really well. The strategy spreads your risk around with those funds. Those are going to give you that average market return, but since you've got a little more in those small handful of stocks, you get the opportunity for those higher returns. Just 10 to 15 stocks for that upside shot if a few of them really take off. So now you've got those 3 to 5 ETFs in your portfolio and only a handful of 10 or maybe 15 stocks. How do you invest new money? When do you add new stocks, or do you just keep buying more of those 10 or 15 stocks you own? Now that question brings up a great concept called dollar cost averaging that's unfortunately hugely misunderstood by beginner investors. A dollar cost averaging, or DCA, just means buying more of a stock at different times and at different prices. You might buy a stock at $15 a share and then buy more a few months later at a different price, adding it to your portfolio. This means the average dollar cost of your shares is going to change. So let's say Apple is one of your individual stocks and you buy 100 shares at $55 each. Now some time goes by, you save up some more money and invest to buy another 50 shares at $80 each. So far so good, but then you drop scalding hot coffee in your lap and sue McDonald's for a huge cash settlement, enabling you to buy 100 more shares at $125. So dollar cost averaging means the cost for those 250 shares, it's not $55 or $80 or $125 each. Your cost for that total amount you've invested divided by the number of shares is $88 each. So then the power of that dollar cost averaging means you don't have to time the market or wait until a stock drops. By continuously buying more shares of your favorite companies, you're going to get the best prices up and down. You don't have to constantly be looking for new stocks, just simply adding more of the ones that you love to your portfolio. Now that doesn't mean that you can't buy new stocks or that you need to sell one stock to buy another. If you do find a company you really like, think the stock is a good deal, then go ahead and add it to your portfolio. If you get to a point where you don't feel like you have the time to keep up with the research and the reports on every stock in your portfolio, just consider selling the 2 or the 3 with the least amount of potential. Nation, congratulations on making it this far into the video. I know it's a long one and there is actually a lot of great information, but I wanted to get to this next part because I'm about to show you how to get free money and a guarantee on the best return you'll ever make with your retirement accounts. Now, there are 3 main types of retirement accounts. Special accounts you set up that are going to give you tax breaks worth tens of thousands of dollars. The names might differ a little depending on where you live or the type of job you have, but the benefits are all the same. And I'm going to start with the big one here, the 401k plan, an investment account you set up with your employer. A 401k is an account you contribute from work, and the best of these 3 in terms of benefits. That's because most 401k plans, the company you work for is going to give you free money. Yeah, free money. Most 401k plans offer some kind of matching, so if you invest a certain amount from your paycheck, the company is going to match that. For example, if you invest 3% of your paycheck, let's say that's $100 every 2 weeks, the company is going to put in another $50 or even $100 into your account. Now, 401k plans are set up through a plan advisor at your work. You'll say how much you want to invest each month or each paycheck and then pick from a selection of investment funds. Your money is going to come directly out of your check before taxes are taken out, and the company puts in its matching amount automatically. Besides that tax benefit, so being able to invest that money before taxes are taken out, the matching amount from your employer makes this a top priority for investing. This should always be the first thing you invest in, and you should always try to max out that matching amount. For example, if your company offers to match or contribute money all the way up to 6% of your paycheck, then always try to contribute that 6% of your paycheck. That way you get the maximum benefit of that company match amount. That matched amount is free money and like an instant return. Even if your employer is only matching your investment by like 50% up to a certain amount, that's an instant 50% return you're missing out on if you don't max this out. Now, about the only negative to 401k plans is the funds available are usually a little more expensive than similar ETFs or stock investing. You'll pay those higher fees on these accounts, so I wouldn't normally recommend investing any more than that amount that you need to max out the company match program, but definitely don't miss out on this one. Your next type of retirement tool is the individual retirement account, or IRA. And with these, you invest money from your bank account, just like a regular investing account, but then you get to take that off your income during tax time. Now, there is a limit to how much you can invest each year in one of these, but if you have money left over to invest after maxing out your 401k match, This is your next priority. Here you see that limit to how much you can add to your IRA each year, and this depends on your income. Married couples with adjusted income up to $204,000 or singles up to $129,000, you can add up to the limit of $6,000 in 2022. The limit increases a little most year, while the amount you can invest decreases as you make more money. And the great thing is, you can invest any way you like in your IRA account, buying stocks, ETFs, anything you would do in a regular account. The only difference is that you get that tax break and cannot withdraw your money until age 59 and a half, or you might have to pay some kind of a penalty. And that's the big question, or I guess the reluctance I hear from a lot of investors. They don't like the idea of not being able to withdraw their money from retirement accounts until that age 59 or later. But really, if you think about this, it shouldn't be an issue. First of all, you're limited to how much you can invest in these retirement accounts anyway, so it's not usually going to be all the money you're investing. For most investors, you'll have more to invest than that $6,000 a year into your IRA or a few thousand into your 401k plan. This other money in a regular investment account, you're going to be able to withdraw and spend however you like. More importantly though, God willing, we will all need that money to live on in retirement. The average life expectancy is around 80 years, while the average retirement age is at 62 years old. That's nearly 20 years you're going to need to live off your investments, and you're going to want to have that money set aside. Folks, just don't pass up on these tax and free money benefits because you don't want your money locked up. These retirement accounts are the best investments you will ever make, so don't miss out. Now, the Roth IRA is actually very similar to that traditional IRA, except you don't get the immediate tax break on the year you contribute. Now, you're limited to adding the same total amount to either a Roth IRA or that regular IRA, all in one or a little in both. The difference, though, is when you get to enjoy that tax break. With a regular IRA, you take that money off your income each year as you contribute, so you get that immediate tax break. With a Roth IRA, though, you pay taxes on the amount just like the rest of your income, but then you get to take that money out of your account in retirement tax-free. You see, when you take money out of your regular IRA in retirement, you're going to add that to your income and pay taxes on that amount. With a Roth account, though, you get that tax-free income in retirement. So really the question here is whether you want to save on your taxes now or later in retirement. Do you think your income tax rate is going to be higher in the future, so you'd want that later tax break with the Roth account? Or if your taxes are higher now and you'd want that instant deduction? But again, there's nothing that says you can't do both, and this is the strategy I use. I break up that annual limit each year, adding a little to my Roth account and some to a regular IRA. Now that means I get the best of both worlds with a tax break now and tax-free income in retirement. Back to the basics though, and you always want to be maxing out that 401k match, then your annual IRA limit, and finally, if you have more money left to invest, putting that into a regular investing account. Now, since we're on the subject of taxes though, I want to show you how investments are taxed and how to save as much money as possible. Ladies and gentlemen, the penalty for not reporting stocks on your taxes can be as high as 75% of what you owe, up to $275,000 and even jail time. But that doesn't mean you should be paying more than you owe. Now, how much you pay in taxes on your stocks depends on two things: how long you hold the stock before selling and your income for that year. You'll never owe taxes on a stock until you sell it. Now, any investments you sell in less than a year of owning them, the profits are going to get added to your regular income, and you pay income tax rates on those. Here are the 2022 income tax rates for single and married filers, and you can see these can get insanely high, especially if you made a lot of money one year and a big jump on Bitcoin or Tesla. You might have only made 40 or 50 grand in regular income, but if you made 100,000 windfall in shares of Tesla and that gets added to your income, that's going to bump you up to that 24% tax bracket and cost you a lot more on those short-term profits. Now, on the other hand, for stocks that you hold for more than a year before selling, those are taxed at a different rate called long-term capital gains. Here are the tax rates on capital gains for this year and 2022. And you see, it's a little different than those income taxes. Whereas with income taxes, you pay different rates at each level of income you made. For capital gains tax, you pay just one rate on all your profits. In fact, you might not have to pay taxes on your investment profits at all. If you look at this column with the 0% rate, if you make less than $83,350 in 2022 and you're married filing jointly, you can sell a stock, take your profits, and not owe any taxes. Even if you made more though, the tax rates are a lot better than those income tax rates. You can make up to $500,000 as a married couple and still only pay 15% tax on your long-term investment profits. This is why it's almost always better to hold your stocks long-term, or at least for a year. Hold those stocks for at least 365 days, and you save thousands on taxes because of those lower rates. Now, there's one more way I want to share to save money on those taxes, and it goes back to those retirement accounts that you should be setting up. Any money you collect each year, whether it's dividends or interest on bonds or another investment, you're going to owe taxes on that amount. It's a loss most new investors don't realize until it's too late and the tax man comes knocking. And here, not only do you lose some of that money you collected in dividends, but you lose the power of compounding interest. You can't make money on that money if you pay it to Uncle Sam. But the way around this is to make sure you're buying your dividend and your income stocks in a retirement account like an IRA. Remember, you don't pay taxes on anything in that IRA or the Roth account until you withdraw the money. That includes any dividends paid into the account as well. And just the difference here can mean thousands of dollars. For example, take a look at this chart. If you invested $5,000 into two accounts, one invested in dividends for an 8% annual cash returns with taxes paid each year on those dividends. The other account, same 8% annual return, but no taxes until you withdraw that money in 30 years. It's a $10,000 difference. You need to keep those dividends in your account, earning more money for you, not paying a chunk of that every year to Uncle Sam. Any kind of cash flow investments, dividends, or bonds needs to be invested through an IRA or a Roth IRA account.
It's a really good feeling opening the account and seeing your total sum of money. I know this is probably the biggest sum of money I've probably ever saved in my life. Really all together in one lump sum. It's empowering again. It's nice. I don't know. It's just something about it. It's addicting. It really is addicting.
Check out the first 4 videos in our 2022 Wealth Creator series with the link in the description below. Or click on the video to the right for everything you need to know about how the stock market works and how to compare stocks. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.